Hey everybody, it's Joel Solomon of PRS and TheRoadmap, and today we're going to talk about the new tab that we call Cash Flow. Now here we are at our login screen, and of course you would click in, you would get that little screen, and you end up at your landing page. You click on Continue to enter your roadmap assumptions. Now here you can see on the very top, you'll see the new tab that says Cash Flow. And we're going to be able to get to that once we input the client information. So we're going to call this particular case, we'll call it Joe Blow. And let's make Joe 47, a male, pick whatever state, doesn't matter. Now whenever I begin working with any case in front of a client, I always start off with the second selection under spend down strategy, which is we want to spend down the assets over the entire retirement period. Now remember, for today's session, I'm really talking about the cash flow tab. So I'm not really even going to get into the client retirement income situation. I'm going to leave all of these defaults alone because I've got to have something in here in order to get to the cash flow tab. So let's just suppose that then I've put first, last name, age, state, I've selected the second spend down. And then you're going to see this section called cash flow. How much is his gross income? And he says $400,000. And what are your current living expenses? And he says about $10,000 a month, $120,000 a year. Now notice that current living expenses includes everything in his home budget, which includes current insurance premiums and whatever he's saving for college if he is currently saving for college. All of that is included in living expenses. This $120,000 does not include, in other words, it excludes what he's putting into his qualified plan. So if he's putting $20,000 a year into his 401k, that's going to go here. That's why we don't include it in current living expenses. And if he's saving, let's say, $5,000 a year after tax in other retirement assets or other retirement savings, that's going to go here. So this $120,000 does not include what he's contributing to his tax qualified plan, nor does it include any other savings to other retirement assets which you would input here. Now you'll also notice the default for inflation is 3% because that's going to impact some things on the cash flow report that I'm going to show you. I also want to point out that your pre- and post-retirement tax assumptions will come into play. So let's suppose that our current effective income tax rate was 30%. Let me tell you what I mean by that. The effective tax rate is total taxes divided by total income. So if I had income of $400,000 and my effective tax rate was 30%, I'd have $120,000 in taxes. That has nothing to do with current living expenses. So $400,000 here times current, that's pre-retirement effective tax rate, is going to impact the taxes that you're going to see on the cash flow report. Now, the other thing that's interesting, so let me walk you through, save and continue, generate results, and let's go to cash flow. So here's our $400,000, by the way, this says current, $400,000 in gross income, estimated taxes, $120,000. And you'll note down here, estimated taxes at the 30% effective tax rate. So $400,000 times 30% gives you the $120,000. So this would give the person $280,000 of after-tax income. We said his living expenses were $120,000. So if you think about it for a minute, 280 minus 120 gives you 160,000 of excess income that he could do something with if this was the example. He's currently, though, putting 20,000 into his 401k, tax-qualified retirement assets, and he's putting 5,000 a year into his other assets. You'll remember that was on our input page. So he's saving $25,000. So out of 400,000 of income, we have 120 of taxes, 280 of after-tax income. From that, we're going to take 120 in living expenses. So now down to 160. We've got to then subtract what he's putting into all of his retirement savings, 25,000, and thus you have, in this example, what his free cash flow is. So 280 minus 120 minus 20 minus 5 gives you 135 of free cash flow. This is really important to help a client understand that he does have money to help him accomplish all of his other insurance and retirement objectives. Now, at that stage, I do want to point out to everybody that I personally only use the first line of this report. For some of you out there, you asked us to create a pre-retirement cash flow analysis. So the inflation factor is going to increase his gross income, which may or may not be true, which of course would increase his estimated taxes. We also have inflation adjusting his current living expenses. But for my use in the roadmap, I just use it in year one. Now, so this is his current situation. You then go back after you've done his planning back in the office, and there is a section for new insurance-related information. Let's suppose you sold him some term insurance. 20-year term is the default, and the premium was $6,500 a year. So you could put that in here. Let's suppose you sold him some new disability insurance, and it was a $4,000 premium. Now notice the default here is continue premium until retirement. But if you wanted to change that to a certain number of years, you could do so here. How about new long-term care insurance? You sold him a policy that has a $7,500 premium. The default would be continue premium until retirement. Or you can specify number of years. Now, if you've purchased some type, or if you're recommending some type of asset-based long-term care policy, do not put that in here. This is strictly traditional long-term care insurance. You've also done your planning, and perhaps you've recommended that he allocate $30,000 a year to an IUL premium, and in this example, your illustration says continue premium until retirement, and that would be your default. So this is giving you the opportunity, after you've done your planning and come up with solutions, to include insurance-based solutions, term, long-term disability, and then an asset-based solution in insurance, which is new permanent insurance. So let's hit save and continue there. Now let's also do one more thing. Let's go to our college planner, and let's put a child down, let's say age 4, and uninflated goal is say $30,000 a year, and let's say they've already saved $10,000 for college. They're saving, let's say, $5,500 a year, and let's calculate it. And you'll notice in the college output that in addition to the $5,500 that the client's already saving for college, and this would be in his current living expenses, what he's currently saving, you'll notice that the system is recommending that he increase his savings by $3,942. That's going to go into the revised cash flow report. So let me show you how it all comes together. You'll remember our current cash flow, $400,000 of gross income, $120,000 of taxes, current living expenses, and how much he was saving in tax qualified and other retirement assets. He had $135,000 of free cash flow this year. Now go here, click on Revised. Now look at this beautiful output. Here's his $135,000 of free cash flow. Now notice what this says, dollars allocated to meet goals. Here are the insurance classifications. Additional insurance expense, the new term, the new disability, the new long-term care, totaling $18,000. You'll notice here it's in red, additional insurance expense, and it comes right here. New permanent insurance, $30,000. That's in green. It's an asset, $30,000. And then the additional amount that the system recommended he save to meet college goals, $39.42 a year for the years that he needed the fund until the child got there. So from the $135,000 that was free cash flow, we're showing him $30,000 in permanent insurance, $18,000 to meet all of his other insurance needs, and another $4,000. So easily in this example, he has free capital to take care of these goals, and he'll still have $83,000 in order to invest in other places for his future. This is Joel Solomon talking to you about the new cash flow report that's part of the Roadmap platform.